Slowly becoming more as a standard for small businesses, a limited liability company, or commonly called an LLC for short, is a business structure that combines the liability protection of a corporation with the tax treatment of a partnership. An LLC is the United States' newest business structure and is the most popular form of business. The owners of an LLC are referred to as members. From now on, we'll be referring to the owners of an LLC as members. Depending on the state, the members can consist of a single person, two or more people, corporations, or even other LLCs. There's two aspects of an LLC that are significant that you need to know about. One is its limited liability aspect, and the other is how it's taxed. As the name indicates, all LLC members are protected from personal liability for business debts and claims, a feature known as limited liability. This means that if the business itself can't pay a creditor, such as a supplier, lender, or landlord, the creditor cannot come after an LLC's member's house, car, or other personal possessions. Because only LLC assets are used to pay off business debts, LLC members only lose the money that they have invested in the LLC. However, while LLC members enjoy limited personal liability for many of their business transactions, this isn't complete protection. An LLC member can be held personally liable if he or she personally and directly injures someone, personally guarantees a bank loan, or if he or she intentionally does something fraudulent, illegal, or reckless that causes harm to someone, or treats the LLC as an extension of his or her personal business, rather than as a separate legal entity. This last exception is the most important because if the members of the LLC don't treat the LLC as a separate business, a court may find that the LLC doesn't really exist and can find that its members are really doing business as individuals who are personally liable for their acts. To keep this from happening, you have to keep your LLC and personal business separate. Make sure your LLC is adequately funded and act fairly and legally to not misrepresent your finances to your vendors or creditors. So if you're doing everything fairly and legally, you have nothing to worry about. Also, a limited liability company has special tax treatment. Like owners of partnerships or sole proprietorships, LLC owners report business profits or losses on their personal income tax returns. The LLC itself is not a separate taxable entity. So again, let me repeat this. LLC owners report business profits or losses on their personal income tax returns, and the LLC itself is not taxed. So in other words, unlike a corporation, an LLC isn't considered separate from its owners for tax purposes. Instead, it is what the IRS calls a pass-through entity. We'll talk more about this later in the lecture. In other words, in the eyes of the government, LLC is not a separate tax entity, so the business itself is not taxed. Instead, all federal income taxes are passed onto the LLC's members and are paid through their personal income tax. So each LLC member has to make quarterly estimated tax payments to the IRS. For these reasons, many people say that LLC combines the best features of a partnership and the corporate business structures. Now that we know what a limited liability company is, let's look at the specific advantages.